Well, hello everyone, and welcome to the Friday edition of your Daily Five for July 24, 2020. I'm Joe Duarte, founder of Joe Duarte and the MoneyOptions.com. I'd like to thank you all for giving me the next 10 minutes of your valuable time. Today, I want to talk to you about what I call the China syndrome, this emerging problem between China and the U.S. I also want to talk to you about 5 stocks with explosive potential for the second half, even as these tensions between China and the U.S. are on the rise. So let's talk about it. We're always at the edge of chaos, the China syndrome, and here's the 5 stocks that we're going to be talking about. My last posting on late June, I thought we might fade into the traditional summer doldrums. That period from Memorial Day at the end of May to Labor Day in September when trading slows down. That's because people go on vacation. But as I noted then, this year is not like normal years due to COVID-19 and, of course, now these China tensions. So we've pretty much had a good summer, but now things are getting a little bit rocky, and we want to be able to navigate this market. The key point is that there are a lot of stocks that have done well this summer, and it looks like there are more stocks that could do well if things don't get completely out of control. That's because the Federal Reserve, as I will deal with in a minute, keeps putting money into the system. Nevertheless, we want to always start with our sound trading principles. We stay with that primary trend. For now, it stays up. I'll tell you a little more in a second. You don't want to fight the Fed. They keep putting money in the system. You want to keep those position sizes small. Keep the volatility in that portfolio down. You take profits where warranted. If you're up 20% on something, take half the position off. Always look for new stocks with excellent charts and sound management. Manage those sell stops. If it drops 5 to 8%, get out and try again later. Of course, always prepare for when the music stops. And we may be at that point at some point in the near future, but we're not sure at this point yet. Big picture again, no summer doldrums. We still got COVID-19. Recession, maybe. The election, definitely a big factor now with this China thing going on. Social unrest, ongoing. And of course, the Federal Reserve. So let's look at the historical perspective here. The presidential cycle. The key point to take is that the third quarter of the presidential cycle is usually the best quarter. I'll say it again. The third quarter, the fourth year of the presidential cycle is usually the best quarter of all 4 years for the market. So we've got some history behind us for the bullish case. Bottom line, the Fed has no choice. They keep putting billions into the banking system. They're buying corporate bonds, ETFs, mortgage-backed securities, and treasuries. And that means the odds favor continuation of the rally unless, of course, something really, really bad happens. Let's look at our first chart, like always, the New York Stock Exchange advanced decline line going way back to the election of Trump. You can see we've been in a bull market the whole time, except for a couple of instances here. We talk about the complexity zone. That's where everything is lining up right for stocks. We also want to talk about the chaos zone, where things are not good and you have disorder. We have the edge of chaos, which is the 200-day moving average and the 50-day moving average. And that's where there's enough chaos and enough complexity to get things revved up and deliver stock breakouts. So we want to talk about the 50-50 rule, which is when the New York Stock Exchange advanced decline line drops below the 50-day moving average, as it did back in October 2019, and it drops also below the 50 point in the RSI. The same thing happened more recently, earlier this year. You can see the break in the 50-day moving average accompanied by the break in the 50 area of the RSI. We're not anywhere near close to that, so for now we say the trend is up. Let's look at some stocks. First one, Best Buy. Well, this thing is completely off the charts, literally, and that's because they're doing everything right. But let's look at it technically. You know, their sales are going up, they're selling the right products, and they're doing it the right way, bringing in customers. So let's look at this stock. Perfect illustration of the chaos complexity 50-50 rule. As you can see, in April, it bottomed out, still in the chaos zone, broke above 200-day moving average, it took off. Recently, the stock broke out. Now it's trading a little bit overbought. It's well outside the upper Bollinger Band, but it's still above the 50-day moving average. We have a little bit of distribution, but on balance volume is good. Momentum is steady, overbought, above 70 on RSI. We can expect a little backing and filling here, but unless there's a big significant break, this stock should be able to deliver gains later on this year, and we may be able to buy it on the dip. Next, PulteGroup. This is a little known home builder. Again, the perfect COVID-19 stock. People are leaving the cities, and you have empty nesters that are been trying to get rid of their big houses at the same time that millennials are starting to get their own houses, their own first house. Families are growing. This is biology at work. This is complexity. There are some things that you cannot change regardless of the politics of the moment. People age, reach certain ages and make certain decisions. This is what happens, and this company is well positioned for that. Again, a little bit overbought right now. It's trading outside the upper Bollinger Band. Look at the big volume here. Of course, a little bit of distribution, not unexpected after a stock delivers a big breakout, but the unbalanced volume is very bullish. Momentum is still good. Of course, the stock is overbought. Same kind of pattern as we saw in Best Buy. And here's the kicker. Our tiebreaker, the volume by price indicator tells us we have good support right here above that 20 and 50-day moving average. Next stock, Hormel Foods. I've been on this for several months, and the stock continues to form a base. But look, it's starting to break out. This is important. When the stock starts to break out and holds above the breakout, the odds rise, as you well know, for further further gains. So here's what's going on with Hormel. We have all this problem with rising food prices. And what does Hormel make? They make Spam. Who doesn't like Spam? They make Mary's green chili. It's terrific. I love the green chili, okay? And it costs a lot less than going out to buy hamburgers and steaks. So people that are pinching pennies right now, rightly so, because the economy is somewhat questionable, are going to be flocking to Hormel. And you can start to notice that the stock is starting to build that in. So let's look at it technically. Again, accumulation distribution, nice and steady. Unbalanced volume picking up. Momentum rising. Not overbought by RSI yet. It's at 65. It's got some room, but it's in the complexity zone. Again, our tiebreaker indicator, volume by price, tells us there's a good shelf of support in this area and not very much resistance above. Hormel has the potential to move significantly higher over the next several months unless something terrible happens. Here's a technology stock. Okay, so why am I looking at a technology stock in this market where the NASDAQ 100 is getting crushed on a daily basis? Well, first of all, let's look at this from relative strength standpoint. Xilinx is not falling apart while the rest of the technology sector is. So what's the reason for that? Well, Xilinx makes a special type of chip called logic chips. And I think of logic chips as blank slates. They're programmable chips that companies can turn into anything that they need based on buying the chip and then putting the software that comes with it and giving it the instructions to make the type of chip that they need. So if you have high demand for a certain kind of chip and you're running out, you buy logic chips, you program them, and then you have the chips available. So Xilinx is in a good position right now because we have all this demand for computing power. So all kinds of chips may be in short supply. Intel just said they couldn't come up with their new high-speed chip and they're getting crushed. Guess what? Xilinx is holding up. So here we are right now about to take out this resistance area at 103. This thing can go above 103. It can move up to 110 in a fairly short period of time. And then there's no resistance at all. Plus, you still got good support in that area. So again, Xilinx is a stock with huge potential in what could be a very difficult market. Under accumulation, unbalanced volume is rising, momentum is stable, and it's not overbought. So my final stock is Repligen. It's a biotech stock. And again, what I'm looking for in all my stocks are companies that are in a niche that no matter what happens, the odds are in their favor. So Repligen makes machines and instruments and reagents that other biotech companies use to make products. So the odds are that if a company is making COVID-19 tests, then they're probably using either reagents or machines that Repligen makes. If companies are making cancer drugs that use biotech and antibodies, guess what? They're probably using something that Repligen makes. If somebody's making specific cancer drugs, the same thing applies. Just about anything that anybody is making in biotech probably requires something that Repligen makes. And you can see that even as biotech stocks have been getting a little bit whipped up on in the last couple of 3 days, Repligen is holding up very nicely. That's because it's in the right niche. Management is doing all the right things. Its recent earnings report was actually quite excellent, and guidance was actually good. So Repligen, let's look at it from a complexity chaos standpoint. Again, well in the complexity zone, above the 200-day moving average, above the 50-day moving average. Pulling back a little bit, I expect decent support in the 128 area. You can see there's almost no resistance overhead. So if it can take out this 139, 140 area, it's probably off to the races. Is that likely? Well, it's quite possible if you look at the unbalanced volume, which continues to move up. You also look at accumulation distribution, which is pretty good. Not a huge loss of momentum, even as the stock is kind of consolidating here, and nowhere near overbought. That means that, again, as with the other stocks I have discussed, Repligen has excellent potential to move higher if nothing terrible happens. Well, I'd like to thank everyone for being here today. That's all I have for today. But as always, focus on companies whose stocks sport those good-looking charts, that they have the excellent earnings, the management is doing the right thing, and focus on whether they're the complexity or the chaos zone. Joe Duarte, thanks for watching. Check out my best-selling book, Trading Options for Dummies. Consider a free trial to my website, joeduarteandthemoneyoptions.com. Full disclosure, I recommend the Repligen, Hormel, Xilinx, Best Buy, and Pulte on joeduarteandthemoneyoptions.com. I also own shares in the company. Look forward to our next visit right here to Daily 5. I recommend watching my second half forecast show, Taming the Uncertainty, at StockCharts.com YouTube channel. We'll definitely talk again.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.